Hey everybody, this is Coach D with TackleTrading.com, here to talk about options pricing. Options pricing refers to the amount of the option premium per share at which an option contract is traded in the live market. Premium is the price paid or received when buying or selling options. This price can be split into two components: intrinsic value, which is the equity for in-the-money options, and extrinsic value, which is based off of the time, volatility, and risk-free interest rate variables that go into the option pricing model. The option price is calculated using that option pricing model known as the Black-Scholes option pricing model. Here we have the Black-Scholes option pricing model. Now that's a pretty fancy math calculation, and what we're looking at here is quite a bit of calculus. And as you can see, you've got a pretty fancy formula, and then you have a handful of variables: P for the stock price, S for the strike price, T for the time until expiration, R for current risk-free interest rates, V for volatility, annualized standard deviation, and they got a normalized cumulative density function and natural logarithm, and all these fancy math functions that go into the options pricing model. Now, a simple memory hook to help you memorize some of those variables are D for delta. That's the sensitivity to the direction the price moves up or down. That's a variable. If the price moves up or down, the option premium changes. T for theta, time. The more time you have, the more premiums built in. The less time you have, the less premiums built in. Time is money, so T for theta, T for time. V for vega, V for volatility. Vega is the sensitivity to the measure of implied volatility that goes into the option pricing model. Then we have gamma, which is how quickly the delta changes. Another way of looking at that is what's called velocity. And you have what's called rho, which is the amount of risk-free interest rates, which would be if you were to put your money into a CD or into a bond type risk-free, low-risk interest rate yield. Now, if interest rates go up, premiums go up. If interest rates go down, premiums go down. These are the variables. You don't need to overthink them because they have the fancy calculators that you can simply just look at the numbers and the options pricing automatically spit out. So the best way to think about the options pricing model is all the variables, the delta, the gamma, the theta, the vega, the rho, all the fancy math goes into the Black-Scholes model. And what happens is the option pricing is spit out. The option value, or the amount of the premium for each specific contract, is constantly calculated in real time. And so whatever you see on the bid-ask spread on the options chain is the current option value, and that's the price which we'll place those trades at. You now have a better understanding of how option pricing works. And for more information on how option pricing works and how you can take advantage of it, visit us over at TackleTrading.com, and we'll see you in the clubhouse.